Welcome everybody to yet another Take Back Control Tuesday. And I want to thank you all for joining us. Now, I can't tell you what the outcome is going to be for each of you, but what I can tell you is what you're about to learn absolutely can change your financial future. If you're here, you're probably ready for change. And what you're going to learn and the insights you're going to take out of this will help you get there. So if the prospect of taking back control of your money isn't enough to keep you glued to this screen right here for the next 90 minutes, then I think we really need to reassess our priorities. And tonight we have an extra special guest, Mr. Carson Herling. And you know, there's an interesting story. I met Carson through his dad. His dad's been a dear friend of mine, and his father was the first person I ever heard on stage say this. He said, the ultimate in real estate is being the bank. And now the legacy passes on, and you're gonna hear from Carson. You're gonna hear about how this has changed his life, but not just his life, his young family's life. So let me just give you a quick overview of what you're gonna learn. There's essentially three basic things you're gonna learn from tonight. Number one, you're gonna learn how to take back control of your money by being the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses, and it's not gonna require you working harder, working longer, or taking on any additional risks. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. If that's not enough to keep you here, well then, you're riding a bicycle home. All right, so that's enough from me. Let's dive in.
Take back control.
Tuesday?
Awesome, guys. Thanks for joining this Tuesday afternoon. We're grateful for you guys. Glad you guys are a part of this whole money multiplier community that we have. How many of you guys, this is your very first time being here? By the raise of, we'll do emojis today in the chat. Raise of hand, you can do a raise of hand. I see that that's an option. You could throw an emoji in there. It's your first time here. You can write number one. If this is not your first time here, like you, Dexter, how many times have you seen this presentation? How many times have you been here with us? Marius, love to see you, brother. Anthony, 10 times. There you go. What keeps bringing you back, man? For those who are new, why is there somebody here who's been here 10 or more times? Countless. Yes, Shane, it is countless. I've seen him here in almost every webinar we do every single week. We appreciate your support. So what we're going to talk about today is how you can become your own bank. I assume a lot of you guys saw different ads or YouTube videos or other things teaching this, which is why you're here to learn more of what this actually means. How can you become your own bank? How is that, or who's been doing that? How can you do that? I assume that's what you're thinking. That's why you're here. So let's get into those things today so you can get your questions answered and you can start building wealth in a way that you can control. So we'll start with a couple questions. Those of you in here, how many of you guys in here are a business owner? You own a business of any sort? Small, large, family business, franchise business, online business, physical brick and mortar building. A few of you guys, okay? Appreciate you guys spending your time with us today, you business owners. Well, if you are a business owner or if you are not, this is going to apply to you. Imagine that you guys, everyone on here individually owned a restaurant. Okay? Own a restaurant. Picture that in your head. If you owned a restaurant, would you eat dinner and take your friends and your family, your close people around you to your restaurant? Of course you would, right? You wouldn't go somewhere else. So what if it was a different business? What if it wasn't a restaurant? What if it was a salon? What if you guys owned a salon or a barber shop and you crushed it in your business? Would you guys get your hair cut at your salon, or would you go to somebody else's or your barber shop? Right? You would never go to somebody else down the street. You'd go to your own business. It'd be silly not to. If you owned a gym, those of you who are gym goers, imagine if you owned the gym. You guys ever go to the gym and see the gym owner not there? And he's always there, and he's always working out at his gym or her gym. Last one for you guys. If you owned a bank, would you make deposits in your bank or Bank of America or somebody else's bank? Your bank, right? All day long you do your bank. If you needed to get a loan for a car or a house or rehab a property, would you go to your bank and borrow the money? or somebody else's? Heck yeah, you'd go to your bank. Why wouldn't you? And if you did borrow money from your bank, would you pay your bank back with principal and interest? Of course you would. You wouldn't steal from your bank, just like you wouldn't steal from your business. So why don't every single one of you guys here today have your own bank? It's because you guys haven't learned how to yet. But that's what we're going to talk about today. We're going to talk about a 200-year-old strategy that's been used by the wealthiest families in history to build their generational wealth through their banking business. You might not have known they were in the banking business. You might not think you're in the banking business. Every single one of you should know you are in the banking business, whether you like to or not. Maybe you're using somebody else's bank, but you could use yours. And I bet you guys know some of these people that are, who I'm referring to have been using this concept for 200 years. Guys like this guy, Mr. Rothschild. You ever heard of that name? Mr. Rockefeller. You ever heard of that name? Guarantee all of you guys have heard of those staple names, because they invented and used these strategies to build their wealth and empire. So that to the point of today, the Rockefeller family is still wealthy. What about Mr. Ray Kroc? You guys know what business Ray Kroc started? McDonald's. You guys know what business McDonald's is in? Is McDonald's in the business of flipping burgers? No, they're in the business of real estate. But how did they start that business? Through this strategy. And Mr. Walt Disney, how did he start Disneyland when he was dead broke in the Great Depression? Through his own bank. And last, recently, Mr. Jim Harbaugh, who's a University of Michigan football head coach before he left to go to the NFL, he incorporated this strategy into his last contract to ensure that he and his family was set for life. He built a family bank that you can do too. People have done this for a long time, and people of recent have done this. So I'm going to show you guys today how you can become your own bank and copy these individuals. And before I dive too deep into it, I want to share real briefly about who I am so you have some confidence in your speaker today. This is my wife and I, Anna Herline. I should update these photos. These are for a couple of years ago. We live in Southern California. We love life. We crush life. We're actually expecting our first baby here in the next couple of months, having a baby boy. So we're super excited about that. But over the past few years, I've met with over 3,000 families across the country, one-on-one, teaching them this wealth building strategy. And this has allowed Anna and I to do some pretty cool stuff, own a lot of real estate, and really build a perfect foundation to build generational wealth. And my story is pretty simple. I bet a lot of you guys actually have experienced something similar. But in my early years, when I was young, I made a lot of mistakes, as we all do. And it's very typical, right? But when I was 18, I did one thing right. I actually went and served a church mission, and I lived abroad for a year, and I served people. Best experience I've ever had. I loved it. But when I came home, it was a little bit different. I came home and I was going to school. And I came home and I had all these different outside influences pushing me different directions. And I, in one hand, held the traditional route that I was going down. I was going to be in a finance program. I was going to learn and be a part of corporate America. And that route made sense for me for a little bit. And then in the other hand, I was around business owners, entrepreneurs, real estate investors. And I saw that the control and the freedom that they had in their life changed everything for them. And I had to decide. These two ideas of how I wanted to live my life were pulling against one another. And I eventually had to make a decision. And I had to make a decision of, do I want to work for money, trade my time for money, a part of the so-called rat race, or do I want to learn how to make money work for me? And that tension pulled these two concepts apart. And it brought me to a point of decision. And that decision was to drop out of school and pursue an education in investing and learning how to make money work for me. And it changed the course of my life. But above all, as I was studying these things, what kept coming back to me is the importance of what I want, my why, my family. And I'm sure you guys have similar, or not similar, but you guys have your own whys and your own families you want to take care of. And so that's what we're going to talk about today, is how you can take care of them and build a family system to preserve and grow your wealth. So as I was studying money, the more I realized I didn't know about money, the more I realized there is so much you can learn about money. And it was almost an ever-ending or never-ending journey of just education. And I still feel like I'm going through that. But this question kept coming up, and this, at least in the beginning for me. And it's what changed my perspective on money. Here it is. The question is, Could it be possible that there are more efficient environments to store wealth outside of commercial banks that we are not aware of? Genuinely think about that for a second. That should be a yes for most of us. Now, I don't think we'll ever get to a point in our lives where we know everything, but this is a powerful question because I want you to start thinking about what you're not already thinking about, what you haven't yet been taught to think about. And I'm sure you guys have all read books like Money Master the Game by Tony Robbins, or Rich Dad Poor Dad, or The Richest Man in Babylon. These are some fantastic books. And what do every single one of these books highlight? They have different laws of wealth building that they all share. One of them that is constant through all of them is know how to save money. If you can't save 1/10 of your income, you are never going to succeed. At least that. It's a harsh reality in today's world because the average American saves more like 2 to 3% of their income. And it's simply not enough. In our American culture, we don't value savings. We don't value the retention of our dollars or the control of our money. And one of the reasons that I'm convinced that Americans are not saving money or controlling their money is because of the environments we've been taught to store money. The places we've been taught to store money are so inefficient that it makes it hard for us to want to save money in those places because they don't do anything when they're there, or it doesn't feel like that. Places like high yield savings accounts, CDs, even 401ks, even leaving money in your dang business or equity in your home. This money is inefficient. There are more efficient ways and environments to store your wealth that maybe you didn't know about. And guess what the answer is? What is the most efficient environment? Your bank, right? And what is your bank? Well, before I share with you what your bank is, I want to share with you what banking is. Banking, it is the business of protecting your dang money. Why are you in business with other banks? They're not going to protect your money the same way you would. And this is a major paradigm shift for most people when they start learning about it. And the interesting thing is that banking affects every single component of your life, whether you like it, understand it, or not. And so throughout this presentation, I need you guys to have an open mind. Because once you see the banking world and how it actually can complement your life and not go against you, you'll never look at money the same way again. And not just is banking the business of protecting money. What's the actual verb of banking? What's the act of banking? It's constantly protecting your money. It's depositing your money, and it's lending money. So again, why are you doing these three things with other banks? You can do it. Why don't you just be in control? Well, how do you do that? Well, you need the right bank set up to be able to deposit money, protect money, and leverage money. So what is your bank? Well, what are the attributes that you guys would want your bank to have? If you were going to set up a bank and a place to store money, what would be the perfect place for you to store your money? What are some attributes of that? In the chat, let's hear it, guys. What do you guys think? What are some good attributes of a place to store money? Some places you would love to keep money if it had these things. Anthony has safety. Love it. Agreed. You want it to be safe. Mr. Sullivan, growth. Yes, sir. We want a little bit of growth. Why not? Right? Trust. Okay. So trust meaning a trustworthy place to store capital. Agreed. What about liquidity? I want my money to be liquid. You put money in a 401k, that thing's not liquid. You're going to have to wait till you're 60 years old till you can touch it. I wouldn't consider that liquid. What if you had equity in your house? That's not really liquid. It's stuck in 2x4s. So we want liquidity. That's huge. We also want growth, like Jeremy said. The average traditional bank in America right now pays 0.07%. Whew, that's nothing, right? What if your bank was going to grow more? What if it was 2, 4, 6, 7%? And what if that growth was actually guaranteed? That would be pretty awesome, right? We want that in our bank. And guess what? That 2-cent check you get in the mail because you kept money in your savings account and you made 0.07%, you got taxed on that. What if it was tax-free? Just what if? Your bank would be tax-free. What if it was protected? Safe, in other words, like Anthony said, safe against lawsuits, judgments, liens, in some states, bankruptcy, divorce. What about the market crashing? It was still safe against all of those things. 2009, guys, 364 banks went bankrupt. My bank did not. If you had your own bank set up, it would not have. That would have been pretty stinking cool. And last, stability in those economic uncertain times. Yes, we want our bank to be safe. Now a question for you guys. Look at this list. Look at this comparison here. Wouldn't this place be a more efficient place to store money? Serious question, kind of rhetorical, but serious. Guys, wouldn't this be more efficient? This is what you could control, as Kathleen wanted. This is a place you could count on. This is a place you could use as really the foundation for everything you do with the rest of your life. And I get it. Life's crazy. Life's busy. You got a lot going on. So the opportunity, well, and it's hard to put time and effort into your money and your personal wealth building because it's a lot. You got to worry about it. You got to manage it. It's a lot. But what if this bank gave you an opportunity to put money somewhere that was still liquid so you could use it when an opportunity came around or you needed it? But it was also compounding interest. It was uninterrupted interest. It was tax-free interest. It was risk-free. It was protected. And to add to that, what if when you took money out of your bank, it would actually not stop it from compounding interest? Whew. Sign me up. Where can I find a bank that does that, right? That is something every single person in America should be diving deeper into. Wouldn't you all agree? Give me a thumbs up or a yes. That if you could store your money in a place that did all of this, you would? Heck yeah. So let's get into what this bank is. I know I've been leaving you on a what's it called? Just on the edge of your seat with this. But here's what it is. I call it a vehicle. Because it's not like we're putting money here and letting it sit forever and never touching it. That's what your 401k is. We're using this as a vehicle to finance stuff. Run money through, deposit, lend, protect, use, just like what banks do with your money. So this is a vehicle you run your money through. Then all we're going to change is just one thing, and it's where your savings goes. If instead of you saving money in a traditional bank, you're now saving it in your bank, problem solved. You just did this whole strategy, the whole 45-minute presentation solved by that one thing. It's just changing where you store your money. And it's going to be in this place instead of where you're currently putting it. And before I share with you what it is, to keep you on the edge of your seat even more, I want to read a quote for you guys by Mr. Will Rogers, who says, "The problem in America isn't so much what people don't know. It's actually what people think they know that just ain't so." That's the problem in America. It's what you think you know, but it's not true. So don't judge this because you don't understand it yet. The vehicle we use is none other than a dividend-paying whole life insurance policy from a mutually owned insurance company. Boring. Right? That might be what you're thinking. I've done this presentation live and I've seen people go on their phones or leave at this point. Guys, life insurance is not boring. It's actually super sexy. It has all those benefits and all those attributes I just shared with you 2 seconds ago. You just haven't been taught how life insurance works. And I'm showing you guys this, and I want to tell you that this is, again, not normal life insurance. This is a specially designed and engineered whole life. And a lot of people have questions at first because they think, Susie Ormans and Dave Ramsey say this is a terrible place to keep money. They say buy a term and invest the difference. All these different ideas. Well, dang, I'll agree with them. If you're going to go get a regular old whole life off the street from your broke brother-in-law who sells insurance on the side, and you're going to have the expectations for it to do what I'm about to show you, I'd be pissed too. There's no way. I'd be really upset. There's no way that would happen. You can't use regular life insurance to do what I'm showing you. You have to use very specially designed and engineered. That's what our company is here to do, is to provide these policies and coach people through how they can become their own bank using this vehicle. And I look at this vehicle and I compare it kind of to a car, a Ford Focus. You guys ever go to the car dealership and see this Ford sitting there, or go on the street? You may have seen a car like this before, right? Super cool, simple, basic, whatever. It's just a simple car, nothing crazy. But let's say when you're on YouTube, if you look up this car and you look up some race car drivers, you would actually see Mr. Ken Block driving this Ford Focus, same car, driving 150 miles an hour, drifting around a turn. Ain't no way you're doing that in the typical streets with this car, right? What's the difference? Besides the paint job, design and engineering of the product. So this policy, we design it to look nothing like regular life insurance, but to look more like a supercharged bank account. So many of you might not be believing me quite yet when I share this with you. But remember a few minutes ago when I told you, or I asked you, would you agree that if there was a place to put your money that had all of these attributes, you would? And I got multiple people saying yes. That was literally 2 minutes ago. Well, that's what this whole life policy can be if it's structured correctly. And when I first learned about this, I thought, oh, no way. I know about whole life. I know about investing. I'm young, I'm learning. I know you can't use whole life to do this. A whole life's got a low rate of return. Whole life's expensive. I even heard some people say that it's the worst investment of all time. And maybe you're thinking, is this whole life thing really legit? Does it work that way? Well, if you're taking notes, which I hope some of you guys are, I would encourage you to write this down twice so you remember it. If anything, write this down. Whole life insurance is not an investment. It has nothing to do with investing or investments. Actually, whole life insurance is considered an alternative asset class and a type of permanent life insurance. If you read the contract, it says that it provides a guaranteed death benefit and guaranteed cash value growth. So if you could take anything from this, no, it's not an investment. So when you go home later today and you're talking to your wife, your husband, your partner, your sibling, your brother-in-law who sells insurance, and they start telling you, I've heard of whole life. It's got a terrible return. You shouldn't do it. As soon as you hear somebody call whole life an investment, you now know that person has no idea what they're talking about because they can't even correctly identify what type of asset that it is, let alone describe how the asset works. You cannot get a policy built for banking from a typical insurance agent or financial advisor. You can only get policies like this from a banking professional, which I am. So listen to people who know what they're talking about and know what banking is so you can then copy what banks do. And there's actually a fantastic book written on the strategy. All of you should go buy this book right now. It's like $15 on Amazon. Becoming Your Own Banker. It highlights the importance of the strategy and how the strategy works. Okay, I'll share with you the secrets from the book. The book says there's a problem that everyone has. And the problem is that you finance everything in life. What does that mean? Finance everything in life. Why is that a problem? Well, I'll give you an example. You could buy a car. Say everyone buys a car. You have a couple ways to buy it. You can save up money in somebody else's bank, i.e. Wells Fargo, Chase, JP Morgan, wherever you choose to store your savings. You could build up 30 grand and then go pay cash for the car. You just finance the car. Maybe you financed it in one transaction, not multiple, but you still financed it. Or the other route would be going to get a car and getting a loan for the car. You spend $50 a month or $500 a month for 60 months, right? It's just something typical. And eventually you'll pay the car. You financed it. But guess what? In both scenarios, you lost all of the money you paid for the car. So that's the problem. You just lost all your capital you were building up. You either borrow money and pay interest, or you use your own money and give up the interest that you could have earned. Think about that 30 grand you paid for the car. You could have invested that and gotten, call it 7% for the next 40 years of your life. That would turn into hundreds of thousands of dollars. That's what you're missing out on by spending your money. And the problem is you finance these things with other banks. What if you just did those same financing transactions? You built up capital and you paid cash, or you borrowed money from a bank and paid it back with interest. But your bank was the one that you did these financing transactions with. Game over, guys. You just won life. You are now going to be rich. Apply that math to every financial transaction you ever make. Game is over. You did it. Solution. It's going to take some time, a few decades, build it up, but be the bank and you're rich. This is why you need to become your own bank, so you can control all these transactions, so you can be the one earning interest always. And it's not just me who does this, guys. Look this up. BOLI, bank-owned life insurance. You will find that almost every single bank in the country owns whole life insurance built this way. Between these four banks alone, they own over, I think it was 70 or 60 billion in whole life. Just these four banks, guys. What you will find is that banks own more whole life insurance, not index universal life, not variable universal life, not term insurance, not 401ks. They own more whole life than they own in land and buildings combined. Sheesh, do that math, guys. Banks are actually the #1 purchasers of whole life insurance in the world. So no wonder they're filthy rich. They're using a strategy where they can become their own banks too. And they're the bank. So are banks stupid, guys? Or do they just know something that I don't know, or that you don't know? Banks are dang smart. They know exactly what they're doing. They're smarter than I am, smarter than you are. We just need to mimic them. So what does a bank actually do? Okay, you guys probably know. What does the bank do? Actually, let's go back to that previous slide. I just skipped over it. Well, when you deposit money in the bank, you deposit 100 grand. Let's say your bank's awesome. They're paying you 4%. You're stoked about it. You have 100 grand sitting in your bank, earning 4%. What do they immediately do with that money you just deposited there? They lend it out for someone buying a house at 7%. Who is then going to pay the seller, who's going to put the money back where? Back in the bank. You see that transaction? You put it in, they took it out, they put it back in with a profit, while you just sat there and did nothing. And then they'll lend it to somebody else on a car note at 8%, who will then pay the car dealership, who will put the money right back in, who will then get a home remodel loan, who's going to pay the contractor, who's going to put the money back where? Guys, you know, who might have some debt he needs to consolidate at 12%, who will then pay off the credit cards, and where will the credit card companies put it back? Guys, who's in control of all these transactions? Not you. Well, you're earning 4, they're earning 7. They're making a 3% spread. They're making a 4% spread. They're making a 5% spread. They're making an 8% spread. You total all of those up. They're making 20% more than you are every single year. But let's do the math really quickly. If you're making 4, right? They're making 20. How many times does 4 go into 20? 5. So they're not just making 16% more than you are on your 4. They're making 500% more than you are on your money each and every year. That is a stat, fact, it's truth, 500%. You can find on BauerFinancial.com that banks make between 400 and 1,300% on the money that you leave there each and every year. Sheesh, yeah, right, Kathleen, crazy. That's why you go to any main town or corner or street in the city or in a big city in this country, and who owns the nicest property on that street? Always the bank. So earlier when I told you guys, these banks are the number one purchasers of these policies, I asked, do you guys think they're stupid, or do they just know something that you don't know? They know what you don't know. So in order to understand what this is, you've got to understand just a couple more things, and then I'm going to give you some real examples and numbers, and we're going to get into some question and answers. So one of those last things I want to share with you guys is the strength of uninterrupted compounding interest. Okay, so when you put money in a life insurance policy, it will sit there and earn interest and compound on itself every single day the rest of your entire life. It will never be touched, never be stopped. It will continue to compound. That is powerful. So have you guys ever heard the riddle, or not riddle, but just the what if question, or the would you rather question? Would you guys rather have $1 million in your pocket right now, or a penny today, but the penny doubles every day for 30 days? After a month, 30 days, it stops. What do you guys want? What would you rather have, guys? In the chat, let me know. Penny or the $1 million? You guys are smart. Of course you know. You want the compounding penny, right? Well, let's show you the numbers here. There you go. All right. The penny on day number 1 goes to 2 pennies on the second day, 4 pennies on the third, 8, 16, 32, 64. We're 8 days in, just past $1. Keep it growing, keep it doubling. 16, 17 days in, 18. Look at day number 30, boys and girls. It is $5.3 million. Woo, sign me up. I'll take the 5 mil. It's a lot more than $1 million. So let's stop for a moment and think about how powerful money sitting there and compounding every day is. Einstein says that that uninterrupted compounding interest is the 8th wonder of the world. I'm sure you all have heard that before. This is why. It's just math. So let's change it up. For real, let's change it. Let's talk about if you were compounding interest, and you doubled every day for the penny, but there was a fee. And I'm sure all you guys have money sitting somewhere with some money manager, and they're charging you a dang fee of 1%, 2%, or 3%. You might not think that's much, but when you compound that 2% against you, it is a lot. Your penny within 30 days will only double to 2.9 million. That 2% fee just eliminated over $2 million of compounding. If it was going to be 5.3 and you just lost $2 million, is that 2% of your 5.3? Heck no, it's not. It eliminated a lot of your compounding because of a stupid fee. Let's do it again. What if you withdrew $100 on the 15th day and the 25th day? You needed to pay for some groceries, right? So you stopped the money from compounding. Oof, didn't think it'd be that big of a deal. It's $100. Well, 30 days, you only get to $2 million. That $200 withdrawal just cost you over $3 million of compounding. Stupid, right? Stupid. What if you took out a loan on the 15th day for $100? Dave Ramsey says loans are bad, debt's bad. Well, in this scenario, what if you took $100 at a 20% loan, but your money kept compounding? You would have still had the 5.3, and you would just have a $100 loan with $20 of interest you would owe. Who cares? Your money kept compounding. You want to continue to let your money compound uninterrupted for this purpose. Last example, Anthony kind of gave a little foreshadow earlier in the comments. He said he doesn't want to have tax on his growth. Well, he's dang right he doesn't want to have tax. You have a penny doubling every day for 30 days. You only grow to $500 if you're taxed at 15%. Just 15%, guys. I'm sure you guys are at a higher tax bracket. 15. And remember, it would have been 5.3. How many of you guys would agree that some of the places we've been taught to put money safely, strategically, to build the best wealth for you have all three of these things going against you? You're going to pay the tax whether it's now or later. You're going to withdraw money when hard times come, and you're advised to do that. And you're going to be charged a fee for keeping money in those accounts. And it's not going to interrupt or compound uninterrupted. It's going to be used. It's going to be tampered with. All three of these factors are going to go against you from building your wealth. And guess what? What place, what environment, what vehicle, keyword, can you put your money that doesn't have any of these things going against you and you get uninterrupted compounding interest? You would get the 5.3, a stupid whole life policy. Guys, it's simple. Your dollars sit and compound every day. If you want to access it, great, take a loan against it. Don't stop it from compounding. That's stupid. Take a loan against it and use your money to do what you need to do. Pay it back. Be the bank. Lend from yourself. Pay yourself back with interest. Great. Now I'm the one in control. So now that we've laid the framework for you guys of the power of life insurance, the credibility behind whole life, who's doing this, etc., the banks and how they do this and what they are operating out of, why you'd want to copy the banks, and now you understand compound interest. So let's get into some real life examples and put this into action to show you guys how you can do this. And then we're going to wrap up with some question and answers. Those of you who are on here, we're at 40 minutes in. If you are new to this video, if you want a recording because you got to head out, please let me know. Email me here at this email. I'm putting it in the chat this very second. If you'd like this presentation emailed to you, or you'd like the Becoming Your Own Banker link for the book, please email me. We're going to get into some questions and examples and questions and wrap up. So hope this has been helpful for you guys. Throw a yes in the chat if this has been helpful. You've learned some insightful things, and let's keep it going.
Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club, it's for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action like so many others have by going to privatemoneyclub.com and sign up.
I'm going to show you guys how to buy a car, or in this case, a truck, and get every dollar back for this truck you are about to buy. Okay? How to get all the money back for any car or truck you ever buy or ever own the rest of your life. Here it is. Here is an actual policy example. Okay? A lot of numbers, big chart. Don't want to confuse you guys. So I wouldn't focus too long on this, to be honest with you. I don't focus on this. I'm going to share a couple things, and I'll dive deep into those numbers with you. So I call this policy a vehicle, right? It's a place you run your money through. And we really need to change our mindsets around the policy when people think about life insurance because they don't understand it. You don't understand yet. When people think about life insurance, the first thing they think of is a dang premium. I got home insurance premiums. I got health insurance premiums. I got car insurance premiums. I hate these stupid expenses and these premiums. Well, if you put your money somewhere that is still liquid and available, like a savings account, do you ever go to your savings account and say, I don't want to pay any more into this? No, it's a deposit. You want to put as much money as humanly possible in your savings account. So if the policy is the same thing, then why wouldn't you want to deposit more and more in there? So it's no longer a premium. Premium's a bad word. I look at it as a deposit into my account. Next, age. A lot of you guys might be thinking, I'm too old to do this. Or you might be thinking, I need more money. I got to be richer to be able to do something like this. Not true at all. Age does not matter. Okay? It kind of matters, but not for what we're doing. If I put $1 into a whole life policy and my grandma put $1 into her whole life policy, it's still $1. It's not worth less because she's older than I am. Who cares? It's the same dollar. The difference is how far that dollar will go. $1 for her might give her a $100,000 death benefit. $1 for me might give me $1 million. So the death benefit on the life insurance will be different if you are older. However, $1 is $1. If you earn 6%, you are earning 6% on $1, whether you're old or young or you live in California or Kentucky. Still $1. So it does not matter. if we're using this policy as a savings vehicle, as a bank, and we're depending on the growth and the tax-free growth or tax-freeness of it and the ability to protect our money here, then who the heck cares how old you are? It's just storing money somewhere. So age does not matter. You do not need to be rich to do this. And the death benefit, sure, it's important. I do want to emphasize that we want to cover people's lives to protect their families. However, I'm not building this policy to give you the biggest death benefit possible. No way. We're building this to have as much money available as possible to accomplish your financial goals, to pay off debts, to make purchases and investments through your bank. That's the sole goal. So the death benefit's kind of just a cherry on top of doing the strategy itself. So now the numbers. Policy year. So you'd fund it every single year. This individual we're going to look at was funding 10 grand a year. That's $800 a month. They made 100 grand a year, so they decided to save 10 grand a year, 10% in their policy. They followed that wealth building rule or law. And over here on the right side, you show cash value. Cash value is what you have access to use. That is the equity or the liquidity, whatever you want to call it. This is what's available in your policy. So if you put in 10 grand in the first year, they had access to 6 grand about. In the second year, they had access to about $12,000 of what they put in. Then it drops to 4 grand. And the reason being is because we wanted to show you taking out a loan on this third year to go buy a car. So let's say you take out a $25,000 loan out of your policy as a loan and bought a car. You loan from yourself. Well, if you take a loan from yourself to go buy a car, how would you repay yourself? Just probably whatever you'd be paying somebody else, right? So if you pay somebody else $500 a month for a car, pay yourself $500 a month for a car. $500 a month is 6 grand a year. Let's do it for 60 months. A typical car note. Now look, you just paid yourself back with interest. You're a smart and honest banker with yourself. So let's just sum the whole transaction up so you can see over time how this works. You've put in $70,000 in premiums to keep depositing and saving money in your policy. You've also put $30,000 in to repay yourself by repaying your policy loan. You've taken out $25,000 to buy the car. So you have put into the policy a total of 75 grand. Net injection into this thing is 75 grand over 7 years. Now, here's the cool part. Look at your cash value on the 7th year. It is $67,881. 67,000 is 91% of 75 grand. So that would mean you just got back 91% of the car you just purchased. You just got a 91% discount on the car because you financed it yourself. If you have access to 67 and you put in 75, you only lost 7 grand over that 7-year period because you put in 75 and only have access to 67. You lost 7 grand. But you paid for a car that was worth 25. So you only paid 7 grand for the car. Now this slide usually takes people a while to wrap their heads around. So I'll give you one more example. Let's say in the 8th year, this person wanted to stop paying premiums into this. Say they're retired, they have no more real income, and they want to stop paying premiums. No more deposits, right? So no more. Their cash value continues to grow. They want to buy a second car. So we'll do the whole scenario again. You take another $25,000 loan from your policy. You pay yourself back $500 a month, just like you'd pay anybody else back. So during years 8 to 12, this is a 5-year period. You have paid $0 in premiums. You have repaid yourself $30,000. You have taken out $25,000 to buy the car. So really your net injection, what you really put in this was 5 grand. So you put in 5 grand over those 5 years. And look how much your cash value grew by. It went from $67,000 to $91,000. Your cash value grew 23 grand and you put in 5. You put in 5 grand. You have a car sitting in the driveway paid off. And you grew 23 grand. You just made money off of buying this second car. Give me a thumbs up or a yes if this makes sense. If you say no, please don't be embarrassed to say no. There's more people who probably feel the same way. Let's look at the whole 12-year period. Over 12 years, you put in 75 grand in the first few years, and you put in 5 grand in the last few years. So you put in 80 grand. You put in 80 grand over the 12 years, and you bought 2 cars, fully paid off, sitting in your driveway. And your cash value is 91. So you put in 80, have 2 cars, and have 90 grand. You just made money off of buying 2 cars because you were the bank, you financed it, you were in control. How freaking sweet is that? And you want to know how this happens? Because benefits I showed you in the beginning, if you put 70 grand into the policy over a few years, that's now going to sit with the insurance company, earn interest, dividends, compound, tax-free, every single day of your life. And instead of taking 25 out and withdrawing it, you're going to let your money keep compounding and take a loan for 25 to buy the stinking car. Yes, you're taking a loan. Yes, you're taking a loan from yourself while your money sits and grows. So there's 3 rules we live by when we're doing this. 1, pay yourself first. 2, pay yourself back and back with interest. And then 3rd, recycle and recapture the interest. Because wouldn't you want to pay the interest to yourself and not somebody else? Recapture that stinking money, guys. If this works for a car, what else does it work for? Everything. Do that math on anything you buy. Guys, isn't this amazing? Who wished you guys knew this earlier in your life? Who wishes you did this last time you purchased a car? Are you going to do this the next time you guys buy a car? How about the next house? How about the next time you pay Uncle Sam? How about paying for a kid's tuition? Who wants to be our next case study, guys? We'll put your whole scenario up and share this with others too. Share your success story. I'll give you a couple more examples, just a different chart to give you a different way to look at this. Then we'll wrap up in Q&As. Let's say you have one debt of 23 grand, and you're paying on a line of credit 9%. You're paying $289 a month on a $23,000 line of credit, okay? How would the money actually move, you might ask? Well, let's say you have 23 grand sitting in your policy. Let's just round up. Say you have 30 grand sitting in your policy. You've put 30 grand into it. That's now sitting with the insurance company, compounding interest, growing tax-free. You have a death benefit, all the good stuff, right? Then you take a loan for 23 grand against your policy. You take that loan, the money gets sent to your bank account, and then you go and pay off the line of credit. Now your line of credit is gone, but you were paying $289 a month to. So now what are you going to do with $289 a month? Pay yourself. You're paying somebody else $289 a month. Pay yourself back $289 a month. And if you were making money in the policy and paying yourself back 9%, because that's what you were paying on the line of credit, you just made money twice on this transaction of paying off a debt. Made money by just recapturing the interest you would have paid somebody else. And what did I change, guys? One thing, just one thing. Where your money went first. Your money went to your policy first. Then you took a loan against it while your money sat and grew to go pay off the debt. Now you still have the original amount and you have the debt. That is how you make money twice on every transaction you ever have. And what if it wasn't a debt though? What if it was an investment? What if you invested at 12%? Someone was paying you 12%. What would you do with your income you received? Run it back in the policy, rinse and repeat it, recycle that money, keep it moving through your system. So guys, 2 things are going to happen to you guys in your life. 1, you're going to live. And are we better off with this than without? Heck yeah, we are. I just showed you multiple ways and multiple mathematical reasons on why you're better off with this than without. 2nd, what if you passed away? What if you graduate to the next life? Well, if you graduate, is your family better off that you had this or not? Well, there is a death benefit attached. They're going to get a huge lump sum and probably have learned from you how they can become their own bank so they can be in control. That's powerful. Yes, your family's better off with this than without. Guys, don't you wish you knew this when you were my age? Don't you wish your kids would learn this while they're young adults or teenagers? Don't you wish your parents started this family bank for you guys? You can start the trend. We've covered a lot today, and I promised that I'd share some very important stuff with you. So let's revisit what they are. I talked to you guys about how banks profit by leveraging your money. So just flip the script and become your own bank. I shared how you don't need to be rich. Anyone can do this with the right tools. And that with inflation, market uncertainty, craziness in life, family banking gives you the complete total control. This is the summation of what we talked about today. If you guys want to screenshot this or take a picture of this to remember this, this is it. If you want to have certainty and control over your money throughout your life from here on out, then you absolutely need to set up a banking policy. I'm so very grateful you guys attended this presentation. Most of you stayed the entire time. You guys are amazing. If you want to learn this, if you want more resources, if you want to have a conversation about how you can implement this, what our company does is we teach this strategy for free. And we help you set up these policies and coach you through using it. We are paid from insurance companies for the business that we're bringing them completely transparently. That's how we're paid. I'm not taking your money. I'm not managing your money. You're not giving this to me. You're not paying me a fee. It's just you setting up your bank and you using it. We're just here as a third party to make sure you're doing it right. And we're paid from them for doing it because we're providing them the business. So it's a great system we have. And all it is for you to learn the concept and set up your own policy for yourself. So if you do want to have a conversation and learn how this works for you, please text me or email me. I just threw my number in the chat. I just threw my phone number. You can copy and paste it easily. I just threw my email if you want to have resources sent to you. If you'd like to just immediately set up time to meet with me, click this link I just threw in the chat as well. So I gave you my number in the chat, my email, and a calendar link to just book directly with me right now. I opened up some slots this week to be available, so there's stuff on there for you guys to click and see when you're free. Please text me your questions, email me your thoughts. If you want resources, let me know. If you want to meet, please let me know. I have about 5-10 minutes here to answer some questions. What do you guys got? Let's wrap up. What are some questions you got? Maybe we do a little bit longer than that. It depends on when Chris wants his Zoom back. But there's some Q&As here. Whatever questions you have, I'm sure somebody else has the question too, so don't be scared. We want to hear from you. Don, you raised your hand. I did see you ask something recently. What are the rules and how do you structure this, he said. I mean, there's hundreds of rules probably that I could describe for you. I mean, there's a set amount of money you're allowed to put into the policy, a minimum and a max based on your income of how much you're able to put in life insurance. There is an application process you have to go through to get approved for a policy. They have to approve you to do this. You'll have to do an application and probably a medical exam. And then the insurance company will underwrite you based on your age, your health, your income, and hopefully approve you to get the policy. But that process usually takes about a month. So that would be the next step, is just to see if you can get approved to do something like this, because who knows? So there's that. And really, it just depends on your situation of what you should do. And the application does not cost anything. The medical exam does not cost anything. It's just filling out some paperwork. Super easy. So you need to apply and get approved for this. And again, if you would like to set up time to meet, please text me here at this number, 702-461-4198. A couple more questions just came through. Doug said, interesting that this could work as intended. I'm looking for a new truck. Wonderful, brother. Go and buy that truck through a policy. Might as well finance it yourself. Might as well make money. Because let's think about it. Logistically, you have an option. You could spend 50 grand today and buy the truck. You could buy it cash, right? You could do that. You spend 50 grand, but then guess what? You just lost 50 grand. You just lost the ability to earn, save, compound interest on that 50 grand ever again. You lost your liquidity. So that's no fun. What if you put the 50 grand in a policy and that 50 grand now sat within the insurance company and grew at, call it 6% for the next 50 years of your life? That will be probably millions of dollars of compounding that you are missing out on by just spending it. So what if you let that money go in the policy, let it sit in compound, and then took a loan against your policy and paid yourself back? Now you keep the principal, you get the returns, and you get the truck. It's actually a no-brainer, Doug. You should be doing this right now. You should do it quick, because if it's going to take a month to get you approved for the policy and you got to buy the truck soon, you should act fast. Who determines the interest rate we pay back? Does the interest go back to your policy? Great question. So if you take a loan from the insurance company, you are taking a loan from them. You owe interest to them on your loan. Current loan rates from insurance companies are around 5-6%. So there's that. You can pay yourself back as fast or as slow as you want. You are in complete control. They're not going to set up a repayment plan, a schedule, an amortization payment plan, nothing. You pay your policy back how you want because you're loaning from yourself. So in most scenarios, we would tell you just to pay back whatever you would have been earning or investing, getting returns with, and just whatever makes sense for the situation. Doug, you said you have limited funds. So great. If you don't have 50 grand today to buy the car cash, then what's your other option? Go and get a loan from the bank to buy the car. That's your only option. If you don't have the money to buy the car and you need a car, go get a loan to buy it. But can't we try and pay off your car faster and start recapturing some of that money and paying yourself back? So sure, go get a loan from the bank to buy your car. If you have to do it, you have to do it. But then let's just pay your car off super fast and do it through a policy. That way you can recapture some of that interest. And yes, Kathleen, miracles do happen. So I appreciate your positivity. A few more questions and we can wrap up. Again, here's my number. I know you mentioned someone here said you want to meet. So here's my calendar link. I'll throw it in here again. It is carson.beyourownbanker.com. All right, guys, what else? What other questions do you got? Man, if I learned this years ago, I would be in a much better position. Heck yeah, you probably would. Don said, would this work with a 401k? I mean, a 401k is an employee-sponsored plan that you can't touch till you're 50 years old. So, I mean, sure, you could take loans against your 401k and purchase something and pay your 401k back. It's a similar idea. It's just it's not tax-free. There's no death benefit. It's not protected. The market can change at any moment. And so it's just, you could do this, but a policy is more efficient. So if you have a 401k, maybe you stop contributing towards it and funded a policy instead. I've seen people do that. If you're in a position where you can stop or completely withdraw the 401k and you have better investment opportunities elsewhere, then great. That makes sense sometimes. Is there red tape for me or for the policy? What do you mean? Jordan said, what did you mean by you have to get these policies through a professional banker? So a banking professional is what I mean. And so if you went to, just say you went to a local State Farm shop down the street by your house, they're everywhere. You go to State Farm or Allstate and say, hey, I want life insurance. I want to do this whole banking thing. They're going to have no idea what you're talking about. They're going to have no clue what you're referring to. So you can't just go to any insurance agent to do this. If you go to your financial advisor and say, hey, I want to do this banking thing, no idea what you're talking about. They'll be lost. Some might have heard of it, but if they don't specialize in it, they'll have no idea how to actually execute on it. They may have heard of it before, but that's really it. So there's that. Banking professional. I just mean somebody who specializes in this strategy specifically, and this is their niche. This is all they do. And they are a certified coach in this. That's what we are. That's what I am. That's what I mean. Is there red tape with the policy? Do they require credit check or formal money usable income? They will check to see if you are a trustworthy, don't have any huge criminal history, have decent credit. They will check those things when they do an application. It is not a hard inquiry. It's just they kind of use third-party sites and find if anything about you that they don't want to, insure you for some reason. I don't know. But if you're relatively healthy, you make enough money to survive, you save a little bit of money, you don't have any serious criminal history or health issues, you're probably fine. No issues. You'll get approved. Is it worth doing if you only fund it monthly for about $900 a month but have no upfront amount? Can you still pull out like $800 to pay your bills with? Yes, Linda. However, you would need to be able to save $900 a month extra. So if you make $5,000 in your month, and you spend $4,000 a month on expenses, and what's left over is $1,000, then yes, we can do a policy for $1,000 a month. You do not need to do anything up front. You don't need to fund it annually. You can just start funding something small monthly and be perfectly fine. You can do $300-$400 a month and start funding it monthly. So totally an option, but we do want to clarify this money you're putting in the policy is your surplus, your savings, your extra. It's not what you need to pay your car and you want to put in the policy, take it out and pay your grocery bill or your gas. Like, we're not doing that. This is not to replace your checking account or a debit card. Not at all. This is more of your savings and long-term savings, investment, emergency fund, that type of thing. Do you have to have a business, LLC, or trust to do this? Nope. None of the above. If you have it, great. If you want to incorporate it, great. You don't need it though. A lot of you guys are still on here. So what other questions do you guys have before we wrap up? Again, if you would like to meet to better understand how this may fit for you, here's my phone number, personal cell. Here's my email if you want more resources or want to better understand. And again, here is a calendar link if you'd like to set up time to meet and discuss how you can incorporate this. Carson.beyourownbanker.com. Jeremy, you've been super active this whole time. Appreciate you being here. Ace, appreciate you being here, man. This is not a universal policy, Don. Definitely not. You cannot use a variable, universal, indexed term. No other product to do banking needs to be whole life. Cool, guys. Awesome. Well, appreciate you being here. I will see you here next week or attend any of Chris Naugle's other live webinars. We're always here teaching, sharing our experiences and what we've seen work and not work. So thanks for being here. Enjoy the rest of your day. We'll see you soon.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.